It's great to see so many of you in the post-lunch coma, food coma. I feel like this is the topic of the hour, certainly of the week, even more so after yesterday's announcement. So I'm absolutely thrilled to have this panel with tremendous breadth and depth and a wide range of perspectives to debate stablecoins versus CBDCs. And in fact, in all of our prep discussions, we were very much opposed to the versus and prefer an ampersand. So that's a preview of where we're going. I also think we're going to throw in a little tokenized bank deposits because, of course, I didn't introduce myself. My name is Erin McCune, and we're just going to jump right in because we have a very long list of topics and 4 panelists, and I want to make sure everyone gets a lot of representation. To start, let's begin with the fundamentals. What core problems are stablecoins, tokenized bank deposits, and CBDCs each trying to solve, and for whom? And I think we're going to start with Simon.
Thank you, Erin. It's quite a broad question, but let me try and summarize. A lot of people have been coming up this week and asking what we do in the digital currency space, and therefore this question has come up quite a lot. So I'm still relatively new to this space, so please jump in, fellow panelists. But from my perspective, stablecoins grew up from the crypto space. They've been used heavily as a means of transfer between 2 different crypto assets or cryptocurrencies. That is a super efficient way of moving between those 2 different assets, and that's gained a lot of interest now within traditional finance and the TradeFi space. So we are seeing an explosion over the last 12 or 18 months of how can stablecoins get used for the same thing, just not in the crypto space. How do you transfer from 2 particular assets, and could it be used for faster settlement? So Circle and Tether and other companies are now doing that, and that's the specific stablecoin type of challenge and problem. There are many other ways of using stablecoins, I'm sure, but that seems to be the main one that's grabbing the headlines. In terms of tokenized deposit, as a company, we, a number of years ago, worked with Wells Fargo for interbank transfers. That was done through a token that we had on our platform. We're now starting to see more and more of that come to light. And recently we had JP Morgan use their JP Morgan deposit token on the supply finance side of things to speed up FedEx and how FedEx move money around. So that's one use case. There are many. One use case of the tokenized deposit space. And then in CBDC, this is where a central bank is tokenizing their money supply and using that to provide various different use cases for each country. There are a number of different use cases out there. Each country has a slightly different take on what a CBDC gets used for. One of the ones that we're seeing crop up as a familiar use case is where the government gives out subsidies or government spending to corporates or individuals within a country, and they want to make sure that is corruption-free and able to get to the right place and be spent in the right way. So CBDC, because of its blockchain and distributed ledger technology, you can track all of that, and there's transparency into that. So that's one use case. Again, I'm sure my panelists will mention several other use cases of all 3. All of them have a common backbone in programmable money. All of them are smart contract based. So I suppose you'll hear the phrase, it depends, quite a lot.
I'm going to ask Renee to chime in and add a little more color there from your perspective.
Yeah, sure. I mean, in my mind, it's pretty simple. There is a lot of discussion around stablecoins and tokenized deposits in particular, and I've had a lot of central banks ask me what can we do to encourage tokenized deposits so stablecoins go away, which I think is an interesting juxtaposition. So perhaps if we go back to the question, like, what are each of those things and who do they benefit? Stablecoins have broken out far beyond crypto now and are used by individuals for remittances. They're also used for savings. We estimate around 50% of stablecoin holdings today are actually savings, which is weird for bankers because there's no interest on those savings. But what it does is it mitigates currency inflation in local currency in emerging markets. It also takes away counterparty credit risk from banks for depositors and creates economic access beyond what was previously available. So you can think of stablecoins as being good for corporates, companies and individuals for moving money freely around the world. Tokenised deposits is great for banks, and those banks that have invested heavily in that are enjoying internal benefits of that, and one or two of their customers that bank across multiple markets with the same bank are seeing greater mobility of their treasury funds in that context. But make no mistake, they're much better for banks than they are for any of the other stakeholders. And lastly, central bank digital currencies, fantastic for banks, central banks and governments. And that's really around creating an economic platform on which to run an economy where monetary policy, enforcement, intervention and oversight become much more effective. I think it's helpful to think about the ecosystem in that way because that explains a lot of what we're actually seeing in the way each of these are evolving. What is interesting is we already have 300 billion of market cap in stablecoins, and the Standard Chartered economics research team estimates that we're going to get to 2 trillion by 2028, and that's largely driven by this emerging market use case. So hopefully that's helpful to think about the ecosystem in that way.
I think that's great. We have a really solid foundation to build on. Let's dive into CBDCs, and I'd like to ask Estelle to share her experience and what's going on.
Actually, CBDC is currently very progressing worldwide. And in our opinion, it's very good and useful instrument exactly for public procurement. And in Kazakhstan, actually, we have this shift of priority from retail approach to wholesale approach, and exactly for public money procurement, due to we could make more efficient. And one of invisible values which it brings also, it's very interesting, it's my observation on our experience, we see that CBDC could be good driver to review and refactor and rebuild this business process inside government bodies. So we could refactor it and make it more efficient, eliminate inefficient intermediates, and make it more effective.
I have a little eGov payments background, and so that really resonates with me. I'm going to invite Sophie to chime in here and share, from your perspective, how do varying policy goals and customer needs shape CBDC development?
Well, CBDCs are very local. They're really driven by the policy of that particular country or region, unlike many stablecoin strategies which tend to be more global. So you have to think locally to think, is a CBDC worthwhile for the implementation in a particular country? And you have to also think from a customer perspective, the customers of that particular country, what are their needs, who are they, and what products and services do they already have access to? So when you think of all of those differences globally, it's no wonder that CBDCs have a local flavour, because they're often trying to solve incredibly different problems. So to give you an example from Australia, the policy objectives behind the CBDC work that the central bank in Australia has undertaken are really driven by efficiency. We're not interested in retail CBDCs because we have the benefit of a fast, efficient domestic payments platform. But we are interested in what could help the economy in terms of productivity and efficiency. And that's why with, for example, Project Acacia, which is underway at the moment, it's exploring how digital money could drive additional efficiency in tokenised markets. It's often said that it's a bit chicken and egg. If you don't have the digital money, you won't get the tokenised assets. If you've got the tokenised assets, you still need that efficient settlement mechanism. So the example that we're looking at to gain efficiencies is the repo market. We're collaborating, the CBA is collaborating with JP Morgan, HQLAX, and the Australian Stock Exchange, bringing together all the essential parties to do tokenised repos, and we're using wholesale central bank digital currency in addition to deposit tokens, because not everyone can access the wholesale CBDC. So you do need both, but importantly, as is a principle of financial markets infrastructure, where you can, you should use central bank money for large transactions and settlement, and so we are doing that either through the wholesale CBDC directly or interbank settlement of the deposit token. So your base, your core level of trust, if you like, is the CBDC. And that's because in this market, the transactions are large. You need that. Innovation begets innovation, though, so we also thought from an efficiency perspective, now that we've got tokenised collateral and we've got tokenised money in various forms, what else can we do with it? A local need in Australia is 24/7 liquidity management. Basically, we're asleep when the rest of the world is awake and vice versa. So particular local need to be able to do 24/7 repos. So we've built an agentic treasury solution which predicts the liquidity position of the bank and then can auto-execute repos when required to maintain our liquidity buffers. So very local needs in terms of 24/7 and efficiency, which guides how we implement or think about the use of CBDCs and other digital currencies.
That's great. It's great to have really practical examples. And of course you're sleeping when we're awake. Yeah, of course. I'm going to go back to Sal and ask, as you think forward, do you anticipate international cooperation and coordination on CBD standards, or is this going to be sort of highly localized?
I believe this interoperability will come, but not so soon as we expected. Actually, we see that worldwide, a lot of central banks are doing CBDC, but they do it with local solution, tailored solution. But of course, we have these CBDC projects which are pushing us towards cross-border payments. But actually, it's difficult due to we have discussion with few central banks regarding CBDC to CBDC connection and make these cross-border payments come in production. But it needs this integration one-to-one. And if we just see what standard will be for this integration, it's very, very difficult to scale. For example, if we could reference to our, everyone knows about ISO 20022. So the first time it was published and announced and proposed for adoption is 2004. And only in 2010, there started some dedicated adoption in some organization. And at the end of 2025, we have prognosis that it will be only 80% of adoption for RTGS only. Of course, thanks to SWIFT, we will have this adoption for cross-border payments. But it took a lot of time. But of course, we see this accelerating of innovation, and some projects very, very fast could move. And I hope that I saw this announcement of SWIFT regarding this DLT infrastructure, which were launched within the SWIFT infrastructure. So I believe we will just look into it and of the possibility to use this infrastructure as trusted, guaranteed environment for CBDC to CBDC connection. And if it will work, I believe this scale and adoption and interoperability for CBDC cross-border payments will go very fast.
I agree. I agree. Renee, I'm coming back to you. If stablecoins and tokenized deposits gain traction, how does that change the role of TradFi? Got a room full of traditional bankers here. help us think ahead.
Look, I think it's a time when we really need to be looking at the revenue streams that we have today and how that is driven by meeting customer needs, or in some cases by the inefficiency of the existing system. So I think, economically, financial institutions globally do benefit from the fact that money doesn't move freely 24/7, 365 days a year. And some of that is just managing that risk for clients, and some of that is a whole bunch of other things. But I think it's critical, particularly if we, as stablecoins continue to grow in their use case, as we think about 24/7 money movement, even with tokenized deposits, really, what is that product or service that we're providing to clients, and how does that change the way that we price, the way that we build products, and the way that we think about that? I think it's going to change the velocity of bank balance sheets. So today, that money creation and payment use cases domains are integrated within the commercial banks across the world. And so if you then think about the fact that maybe deposits will spend less time on bank balance sheets because the velocity of payments is increasing, or maybe bank deposits might migrate towards stablecoin reserves, that really changes the way we think about credit creation and the role of that in the different markets. This is going to be very asymmetric. There isn't a uniform stablecoin regulation. There isn't a uniform approach to tokenised deposits. There's not a uniform approach, as Sophie rightly said, and Estelle pointed out as well, that this is a very jurisdictional focused thing for CBDCs. So what I think is likely to happen, and this is just a guess, we're likely to need clearing systems that go between central bank digital currencies, similar to some of the conversations around Project Agora, which the BIS is leading. We're going to need clearing systems between tokenised deposit ecosystems, because tokenised deposits are great for mobilising cash within a commercial bank and much less good at mobilising cash across commercial banks. And so that clearing network, such as Partior that we're invested in, there's several others as well, will be needed to help that mobility. But if we get that increased velocity, we really need to think then, how are we funding our assets? What does that do to some of the more strategic views from a treasury perspective for banking? And I think the outcome's likely to be better for the individual and for corporates and for the economy, right? We're moving from, so I guess I used the example this morning where today we've got access to a huge volume of information in our hand on our mobile device. But 30 years ago, 40 years ago, we had to go to Dad's office and look up the Encyclopedia Britannica or, the dictionary to find out an answer. And today, the way money works is kind of like that, right? So we've got internet and e-commerce platforms that work 24/7. Most of us don't have to go out of the office in our lunchtime to go shopping because we've got access to 24/7 retail for all the things that we need, and that gets delivered to our door. But money doesn't work like that yet. And I think that's as human beings, we all want money to work in the same way as the internet works, because we've proven that that's kind of convenient. So from a banking perspective, we need to step up from that way we organise ourselves today and have a look at what is that actual money problem that we're solving for clients, and how are they using those different forms of money to solve their problems. So yeah, lots of change.
Lots of change. That's why we're all here learning. Sophie, do you want to chime in a little on that question, or should I send you in the direction of talking about disintermediation? I leave that up to you.
I love a choose your own adventure question. Thank you.
Yeah.
Let's go into disintermediation, because I think it's probably something that, as Renee has outlined, there's going to be a lot of change. So what does that actually mean for banks' existing relationship with customers? Firstly, I think we shouldn't be complacent. This is a significant shift. And if you're thinking that this is all going to disappear, I really recommend think again. I don't really think that many people are thinking that anymore, but they have been in prior years. It's interesting to note the shift in tone now that this is real. One thing I'd note about potential disruption is it's really good for customers, because usually there's a reason why you get that early demand. There's something there that is of value to customers. So the approach that we take at CBA is we look for that demand signal. What is it that customers are seeking? What is different? What is better? And what should we do about that, if anything? When I reflect back, the very first stablecoin pilot that we launched was in 2016, 9 years ago. And we just piloted it with staff, and we thought, this is really interesting. I wonder what you could do with this technology. But we couldn't work out what the unmet customer need was. So we thought, this is interesting, but not essential at this point in time. Fast forward to today, we've got many more assets which have been tokenised. So there's something for tokenised money to interact with. Certain stablecoins have achieved scale. And we've realised, I think, that all sorts of forms of digital money need an upgrade, if you like, a new form factor to make them ready to interact with in a tokenised world. So I think it's interesting for banks to consider that as there's a threat of disruption, when we're at our best, we should adapt, adopt, or acquire. We don't always do it perfectly, but there's many avenues that we can go down there to get involved. And I also think it's interesting to reflect that in prior years, I've constantly heard stablecoins are a great way to avoid banks. You no longer need TradFi. I don't believe that's true now. I think people have realised the reality is banks may be holding or managing the reserves. They may be providing the on and off ramps. They may be the providers of liquidity. And they could also be the issuer, either on a standalone basis or collaboratively. So it turns out for stablecoins or StableFi to reach its potential, it needs TradFi. That's a huge opportunity.
Thank you. Simon, I'm coming back to you.
Okay.
Do you want to share with our audience some of your observations about progress that's been made in enabling central bank money to settle DLT transactions?
Certainly. So I think Sophie touched on it a little bit with the Australia use case. I'm going to move to this continent and somewhere slightly closer with Switzerland. So we've been working closely with the SIX Digital Exchange, and part of their company is a platform called SDX. Through Project Helvetia, we partnered with them to launch the ability to settle a CBDC, or use CBDC to settle a digital asset. So that is one of the first digital CSDs that exists in the world. There are a number of CSDs now, or platform vendors that provide CSD software, starting to look at how can they offer a similar digital CSD experience to their customers and their clients to mirror what's happening in Australia and now in Europe as well. So I think the momentum is there. People are looking with interest as to, as digital asset volume grows and as that takes off, how do you make sure not just a central bank, but also a settlement and depository can process that volume as well as the traditional aspect of it. So you know, people are looking to upgrade and looking to move and support all of that. Back to your point, right, is that an acquisition? Is it a new build? Do companies come together to offer this as a facility? I think we are going to see a lot of that movement in the next few years as people start to take account.
And it depends.
And it depends.
It's going to vary.
Yes.
Estelle, do you want to add any more on that topic?
I think it's just in progress. So we will just see in Kazakhstan, we see the same trend, and actually we are partners with R3. So we have the same, I believe, vision of how it should work and should be. And it's very interesting thing regarding stablecoin, and it's incorrectly to say VS CBDC. It
Yes.
should be and.
Yes.
In my opinion, CBDC is closer to wholesale, and I have some. Okay, it's my earring. Sorry, guys. And stablecoin closer to retail, and for CBDC we have few projects running in pilot environment, and actually it's not a test; it's production in dedicated participants. So we could really feel how and touch results and receive real value. And it's definitely work for public procurement, for public money spending. It definitely work for some DVP payments, and it definitely work for efficiency of tax reversal processes. And we have such projects right now running. We have good results, and I'm just sure we will have more results in the next year, I believe, due to we have this plan to have 100 projects, 100 business processes in CBDC.
All right, we'll hear about that in Miami. Looking forward to it.
I hope so.
Yeah. Renee, I'm coming to you. What is a realistic timeline for high volume cross-border CBC or stablecoin settlements, like at scale?
I mean, now for stablecoins.
Well, yes, for stablecoins. Yes.
I mean, that's already happening. We're seeing that in the remittance use case. We're seeing that in corporate payments. I think that we spend a lot of time on both tokenized deposits and CBDCs and the cross-border context. In order to achieve cross-border payments at scale between CBDCs, we need networks that connect CBDC infrastructure. Whenever you have to build multiple infrastructures multilaterally, that takes time, right? And that's just a factor of the fact that you're building point-to-point connections over and over again. So I think when we think about that, it's an infrastructure problem. So I think there's several initiatives, that have been underway. So mBridge, Project Agora, several others as well to connect CBDC networks. I think that will continue. I think the bigger question is around going back to that jurisdictional question. What's that threat? I mean, it's very impressive from a sales perspective on that 100 processes on CBDC. This is the real use case of moving money on that CBDC infrastructure within a jurisdiction. So the question jurisdictionally is, okay, what are my economic benefits and overall benefits for a CBDC from a policy perspective, from a central bank perspective in terms of managing monetary policy, etc.? Are there ways that I can make economic interventions more effectively if I can drive scale on my CBDC? These are the key questions. But at the same time, you've also got some threats, right? So stablecoins, because they're so freely transferable, there is a risk in large-scale adoption of US dollar stablecoin that we start to see the substitution of local currency for US dollar stablecoin. And I'm sure that is certainly weighing on the minds of many central banks. So the question then is, how do you respond? I think in the central bank conversation, there's definitely the economic play around CBDC, and I don't think the use case of a slightly better RTGS is going to get us there. I think it needs to be much more broadly beneficial from that, and I really like the way Asel's been talking about that from a Kazakh perspective. I think that's a broad thought process around CBDC. But what else do we need to do? Do we need stablecoin regulation? Do we need a regulated issuer? Do we need to think about our own currency issuance in stablecoins? How does that, what are those conversations? And I think they're very real considerations for many, many central banks today. So I've got a lot of sympathy for central bankers. I think we've moved from a world where all of the rails were well known. The central bank had basically ubiquitous control over the domestic currency, to a point where actually a lot of those assumptions that are in economic models, in economic policy, in central bank policy, potentially no longer hold true. And so that's quite a lot of work in quite a short space of time for all of the central bankers. So the only thing I'd add, and this comes back to that timeline piece, this will be aided by commercial banks leaning into that conversation with central banks and regulators. It'll creating connectivity in the ecosystem will actually create resilience and protect from the potential financial stability issues if we end up with this massively fragmented ecosystem. And so I think that that conversation, that integration between commercial banks, other ecosystem players, stablecoin, central bank, digital currencies, and tokenized deposits in each jurisdiction is an absolutely critical conversation. And the better that works, the closer we are to CBDCs at scale.
Great. Simon, do you want to add anything either in terms of enablers or sort of challenges that we need to address as we attempt to accelerate the timeline, expand the scale?
I think you touched on it with the one word, infrastructure. That is critical to getting any central bank to a point where they're running a 24/7 money system, right? That's not something they are traditionally used to doing. We are seeing various economies and various central banks starting to embrace that and starting to realize what that actually entails. But to run a always on, always up, 5/9 security, high available system to run your currency, that is a huge infrastructure project, not to be underestimated. So there is a lot of commitment needed by the central bank and the commercial banks that will talk into that ecosystem as well to start to build the infrastructure, right? Start to put the groundwork in to make that happen.
Let's stick with this regulatory and policy topic a bit further. How should regulators be thinking about the balance of, the allure and the promise of programmable money, but the real risks in terms of misuse or, concerns about surveillance and privacy. Renee, do you want to dive in there?
Yeah, there's a lot to unpack there.
Yeah.
Everyone else is smiling because I'm getting to deal with it first.
Yeah.
Look, there's a couple of things that I've observed in regulation which I think are important things to consider. First of all, most crypto and stablecoin regulation doesn't contemplate the idea that commercial banks will participate, and that's pretty painful for everybody. So I think I would encourage every regulator to assume that it's a good idea to have commercial banks participating in stablecoins, cryptocurrencies, as well as tokenized deposits and central bank digital currency. And the reason for that is, if you don't encourage that, you end up with hiving off that part of the ecosystem, essentially outside the banking system. We see in many, many markets where all of the crypto exchanges bank, instead of banking with the large balance sheet local banks, which have capital buffers, investment budgets that can build risk infrastructure and all of those things that we want for a stable economy, we end up with a large concentration of stablecoin and crypto activity sitting on top of small mid-tier banks in various markets. And that in itself is a stability risk, because who does the small mid-tier bank borrow from? All of the large balance sheet banks. We had some events in the US a couple of years ago which resulted in a requirement for FDIC to step in to prevent a credit crisis in the US. And I think that that's a helpful example. It wasn't all related to that, by the way, but it's a helpful example to think about, well, what is in the local ecosystem that could be a stability risk, because there's an assumption that by discouraging participation, we improve stability, and I don't think that assumption holds true. The other one, is capital. I've not met a central banker whose solution to an issue is less capital for commercial banks. So that tends to be that they only go in one direction. But one of the challenges of that is, the more capital pressure we put on commercial banking, the more likely that capital and innovation moves out of commercial banks and into less regulated entities, whether that's on the asset management side, the venture capital side, or indeed with fintechs and cryptocurrency players. So I think a thoughtful approach to capital, and the Basel Committee on Banking Stability has done some work on that, and I think that's been an exceptionally conservative approach. It's good because there's clarity. It could be better if there was mathematics that was more constructive around recognition of the activities that are being done. I won't get on that bandwagon for the rest of this panel, but just that capital is an important part of that. In terms of financial crime and that surveillance and privacy piece, so surveillance is really critical, but it's actually much easier and more effective on large-scale public blockchains than it is in the existing financial infrastructure. Not only that, but law enforcement also has access to the same data at the same time as all of the rest of the financial institutions. So rather than working on data that's 6 months old, that's the result of a subpoena to multiple financial institutions, you have real-time visibility. The convictions that came about as a result of the Terra Luna failure and several other failures were so much faster than with previous fraud cases or white-collar crime cases, simply because the data was so readily available. It's interesting to compare, let's say, Enron, the time of the collapse to the time of the prosecution, versus Terra Luna as an example, or even FTX for that matter. So I think all of that contributes. I won't dive into privacy because I've hogged the microphone for long enough, but
I was going to ask Estelle to chime in and add a little bit color there, and I don't know if you want to go down the privacy route or hit on or reinforce any of those other points.
In case of Kazakhstan, actually, we prioritize privacy in all our business processes. And for example, we have embedded rule. If we name it reverse marking. It means if tokens was marked at issuance or minting, when this token credited to individual's wallet, it unmarked automatically. It's very important for us to keep privacy. So yes, we could track how token was spent during this chain of, for example, public money procurement. But when individuals receive that money as salary payment or as payment for some services and so on, for us it doesn't matter how he will spend it. It's his right to do it. That's all.
And are you finding that that is well understood and driving comfort with using these new tools within the community?
Actually, we strongly believe that it's a very correct way to do it, and it's take from us a lot of effort to make this information publicly available. Due to, of course, citizens and society just want to say, now government will tell me where I could spend my money. No, for government it doesn't matter how you spend your money, if it's individual money. But if it's public money, which was gathered from our taxes, I want to know how government spend it and what exactly I receive from it, like social value and benefits.
So you turn it and say,
yes,
we will give you transparency, but we will not be looking at what you're doing.
Yes.
Nice, nice. Okay. Let's stay on regulators a little bit longer. Actually, we'll broaden it. Regulators and industry participants. What practical, tactical steps can we make in terms of governance models that will combine sort of public oversight, private sector innovation that will, along this trust theme, really drive acceptance and proliferation in the mainstream of these new capabilities? That was sort of a long-winded and rather disjointed question. So Simon, just go in that general direction.
I'll go in that general direction. So I come from a traditional banking world. It is a heavily regulated environment. You have ratings agencies, you have lots and lots of different regulations that you need to adhere to. I had a fascinating conversation as a walk-up yesterday from S&P, who have started to think about how do you come up with a rating for digital asset space. But the interesting part for me was, rather than look at the asset itself, they are looking at the protocol. So how do you come up with a rating for a specific protocol? How do you link that back to who the issuer behind that protocol is? And then, like every ratings agency, it has to fit into the AAA down hierarchy. So how do you link that back to more of a traditional finance space? So I think things like that are starting to happen and starting to come into fruition. And I'm sure there will be Basel IV, Basel V, MiFID III, like all of that will have to cover digital assets at some point. But thankfully, I don't work for a bank anymore.
Speaking of banks, Sophie, do you want to chime in here?
Well, speaking from a private rather than public perspective, because I guess the foundation layer for trust is regulation, but we have to leave that to governments, actually, not regulators. Regulators can only regulate what the legislation says. So, government and their policies will implement appropriate regulation that provides the foundation layer. And then in the private sector, it's really incumbent on any issuer or perhaps distributor of a digital asset to make sure that they are thinking from a compliance-first perspective and have an appropriate governance layer and make that visible to customers. Particularly important in this space where you have some digital assets that have focused on, and successfully focused on, scale rather than governance, because they existed in a non-regulated space. And they've been very successful at that. But as markets mature and regulation occurs, the modus operandi has to change. So that's what the private sector needs to think about. Governance, sharing that they have a compliance-first culture, and also, of course, to engender trust, you have to take care of the customer. So if there's problems, you have to try and fix them for them. Sometimes that hasn't existed either, so not so much at the protocol level, but at the human or operational layer. That's also very, very important. So it starts at simple UX, and then it goes right through to, if there is a problem, it's not necessarily someone you can call, but there's some pathway to get your problem fixed. That's also been missing to some extent to date, but is necessary to build trust.
And I think I'm just going to chime in here, because naturally, I think in this world that's getting more 24/7, that ability to anticipate an issue and for the institution to be proactive with their customer and say, "Oh, actually, are you sure? Have you thought?" there's just a way to turn that into something more, less reactive.
Yeah.
And that may turn out to be a good thing for all of us. We're running out of time. I'm going to ask a question that at the time that we started planning this, maybe was the right question. Now I'm not sure that it is, because the question is about, what is the tipping point? And I sort of feel like we're toddling on it right now. So as you look ahead on, for our audience, what are going to be the most important drivers of momentum, the accelerants of this trend? And I'm actually going to ask this question of all of you. So I'll start with Issa.
Actually, it depends. First of all, it depends from global financial trends. Due to national strategy, actually, anyway, will depend on global trends. Second one, it depends from each country or stakeholder objectives. If it's CBDC, you should ask why you need CBDC and what problem you're trying to solve. Due to, if you don't know the objectives, it's better you spend a year to identify the strategy than just spend 2-3 years building something without strategy. So it's very important. Regarding stablecoins, I believe we see this adoption, but we see that some financial institutions, for example, in Kazakhstan, having problems with corresponding banks due to their trying to use stablecoins. So that means we need this global adoption and to understand how we evaluate risk in each financial institution and how we could share this practice, how we share it to make it transparent and understandable by all participants. It's very important. And just to announce one thing, in September in Kazakhstan we launched first stablecoin backed by KZT. Till the December we will launch one more on Binance, and we hope that it will accelerate the innovation on market. Due to we will after the stablecoins we will launch few projects related to real estate tokenization, real-world asset tokenization, and we'll announce some crypto hub, crypto city, which will bring this innovation in life in very dedicated, with separate regulation place to try all these mechanisms and models how it could work, and only then bring it to life with a real country-wide scale. So I believe we just need to try. Due to we could have a lot of schemes or understanding in our minds how it could work, but real world usually brings other outcomes, and we need to really see how it could work in real life, and then only to make this last mile regarding regulation frameworks. Due to you just will regulate something you doesn't know how it will work.
Thank you. Simon.
So I'm going to talk about a different new technology that probably didn't have a consequence that it's ended up with. So quite a few number of years ago when the iPad got launched, I remember being given one to try, and it was given to me as a way to read magazines or read the news. It's like, okay, it's a slightly bigger tablet thing. I can scroll through it, and it's good for reading. This is a sensible thing. It probably wasn't designed to keep children quiet in restaurants or make sure everybody gets addicted to YouTube on a slightly bigger scale. So there's bound to be use cases and adoption of these new technologies that none of us have thought about yet. Somebody somewhere will invent it.
Lightning round. So enablers, motivators, accelerants. Sophie and then Renee.
So enablers for CBDC is actually politics. So it's government that implements, not the central bank. For deposit tokens, there's a long way to go, but it's regulatory. There's a lot of uncertainty there. I'd say it's behind stablecoins in terms of tipping point, and yet it's essential because in advanced economies, 80 to 90% of all transactions are still done in commercial bank money. So it's the upgrade we need. There'll be a lot of momentum, but we need greater clarity. And then for stablecoins, I'm going to come back to infrastructure. Infrastructure and ecosystem is both needed for to reach the tipping point, which I would say You say we're already there. I'd say it depends where you live as to whether you think you're there.
It depends, of course.
It depends.
Go ahead, Renee.
So yeah, basically, I agree with Estelle. You can't learn to ride a bike by looking at it, so you have to start. And so that's kind of, you know, the way that what Estelle laid out, I think, is a helpful construct for how jurisdictions can drive acceleration. And the other thing is people who need problems solved will use the money that solves their problem, and that's what actually will drive the adoption of all of these things.
Thank you very much. This was really, you guys were great. Thank you. And thank you for your time and attention.